today's class. So today's class, we're going to start out with the Blackboard app. And then also we will go down to chapter 2. I'm not sure if we'll finish chapter 2, but we'll give it a shot, the chapter 2 handout. Yeah, so if you pull up this Blackboard app issues, that's a, what's it called? I can't see, I got stuff on my screen. It's called Blackboard app issues. Of course it is. All right. And basically there's two rules for the Blackboard app that for this class anyways. And I don't think many of you are doing this one. Do not click on save as draft. If you do save as draft, it does not submit it. It doesn't do anything with it, basically. It says, okay, I want to hold on to this and look over it before I enter it. Now, there is a confusing thing about this, though. And that is you'll get this message. If you say save the draft, save as draft, you get this message that says assignment is complete. Review submission history. It says the assignment is complete. It does not say that it's submitted. Very confusing. But so if you do hit save as draft, and it's basically there if you're doing like a test or something and you want to save it, not submit it. Usually it's for something working in Blackboard, like a Blackboard-based exam. Just know that until you you can pull it up and hit continue, and I'll show you that in a minute here. But save as a draft, it'll show that the assignment is complete, review your submission history. The complete does not mean it's submitted. It just means that you have a file for it. So again, confusing, yeah, because you look at it, hey, it's complete. Why isn't there a grade in? It's not submitted. This is the one I think is probably the one that's causing the most headaches. And that is document was supposed to be closed before being submitted. So if you have a document up, if you have your Word document up, you try to submit it, it'll show it submitting, but it'll show on my end as pending. It says that it's still open. Now, I think the reason why this is coming up in the Blackboard app more is if your phone's like my phone, it's hard to tell what is actually open still. So I think that why this is happening in the Blackboard app more than on the other stuff is that it probably is you're not aware that it's still open. And so just make sure if you're using your app that you close the document before you submit it. And that's not just for this class, that's for any class. Because if it's open, there's a good chance that there's going to be a problem with it for whatever reason. But anyway, so make sure you close the document. So if you're doing a test, save it, obviously close it, and then submit it. So make sure you close the test, close the file before you submit it. Any questions on that? What do I do here? There's another one. There's a third one called some third thing. Blackboard pending assignment problem, and this kind of is for the if you submit it as a draft. And here is the part that's a little bit confusing. When you click on it, so you save it as a draft. When you click to see what the status is on it, you'll get something that looks like this. You have to hit continue for it to get to submitting it. Again, it's not that's not intuitive. You look at it and it shows an attempt, but you see this little blue thing. That's what I see. So don't save as draft. This is exactly what I see if if you submit it. And I can't get rid of it because it says there's a student still working on that. You can't stop them. So if you get this, you get to this tab, if you see that blue thing, that little blue whatever, that means it's not submitted, and I can't do anything about it because it's like holding it open. So hit continue, and then you can submit it. Here. But the save as a draft thing, there's a reason for it. I mean, it's so you can look at your stuff before you send it in. However, just know that does not send it in, and you're going to get confusing screens. It's going to say assignment completed, and when you click on this, it's going to say, here's your grading attempt. Okay, that looks fine. It's actually not submitted at that point, so you have to hit continue. Is it confusing? Yeah, they picked better ways of naming these things. Yeah, but I mean that's what we're with. So, and again, that's not just for this class. That's for any class that's using Blackboard, and virtually all of them do. So, any questions on that thing? Okay, so yeah, so just not that. Just make sure And then for this class, you really don't need to do save as a draft. And the reason I say that is even if you submit the wrong thing, there's unlimited submittals. You can just submit another one. So the save as a draft for this class is really not necessary. It might be necessary in some of your other classes where you're doing a test and you want to, save the draft before you submit it and take a look at it. But as far as this class is concerned, there's no reason to use it. And again, I think this one is probably the bigger culprit, my guess, my uneducated stab at this is that it's probably, like say in my phone, it's hard to know what's wrong. And so if you may have the document up in your phone and not realize it, but it has to be closed before you can submit it. Any questions on that? Okay. Well, let's jump into the headaches that are not associated with Blackboard, but the headaches that are with accounting. All right, so this is a chapter 2 handout, and we're gonna kind of continue on. Again, wacky that, journal entries used to be regular journal entries you'd write out. And over time, they evolved or devolved into, hey, what are the accounts we need, the amount, and go on. And so it's a shorthand, it's a very condensed shorthand is basically what we end up with. They're still called journal entries as a holdover from when we used to write journals. Not done so much anymore, at least in accounting. I can't remember how far we got here. Oh, here we go. Stop. Okay. Okay, so we get to number 6. So we'll start up on number 7. And
I thought we got further than this.
that must have been the first stop.
I think we stopped at
The last thing I had down is the last number I had down is
13.
13.
Okay. So I should take these stops out when I put them in. Right? Okay. Well, we should definitely finish it today, then, I think. I think we're going to go to 28, so there's 15 of these. Okay. So 14. First thing we got to do is figure out what accounts we're using. Received cash from a customer previously billed.
Cash and accounts receivable.
Yep. So previously billed to be the accounts receivable. And oops. Okay, cash accounts receivable. Cash, increase or decrease?
Increase.
Increase. Accounts receivable?
Decrease. Or no. Yeah, decrease.
Decrease, yep. Okay, and let's see. So what kind of an so what kind of account is cash?
Asset.
Yep. Yeah, so these are the accounts that we have to choose from. Let's make those yellow. I don't know why, but they're yellow. So these are basically the choices you have for where these accounts go. And yes, cash is an asset. And accounts receivable?
Liabilities.
Nope.
Then an asset.
Yeah. So this is accounts receivable is when somebody owes us. And again, the reason we count it as an asset is because we're going to get cash for it, which is like what we did just right here. This is why it is an asset. So we're going to put in an accounts receivable. Now, accounts payable would be a liability. So accounts receivable, I'm going to bold that. This. Hey, I go on the second layer. Okay. So these are the two accounts. They're both assets. One is increasing and one is decreasing. So the cash is increasing. So cash will be a debit or credit.
Credit.
Nope.
Debit.
Yeah. So 6. Okay, so cash is going up. So it will be a increase. Oops, not there. It was going up 700. Okay, accounts receivable is going down. So it will be a credit. Uh, 700. So they no longer owe us the 700. Oops. Now, you don't need to put this asset increase, asset decrease thing in there. I do it just so that you kind of know how I got the debit and credit. But notice you have to know what kind of account it is to do the journal entries. And there's only 5 choices, but you know, if you have to figure out which one of these actually falls into, because it makes a difference. Sometimes the credit will increase, sometimes the credit will decrease. By the way, just in case you're wondering, oops, let me go somewhere else. If you're wondering why why you hear the term credit, you know, so if like a bank says, "Oh, we'll credit your account," the bank is telling you from their point of view. So if the bank says we're going to credit your account, it's because to them, liabilities, what they owe you, are credits. So when they say they're going to credit their account, they're not telling you from your point of view. From your point of view, it's a debit. They're telling you from their point of view. From the bank's point of view, it's a credit. We owe you more money. So it's kind of one of the weird things about debit and credit. So when you hear credit, you think, oh, that's money going up. When actually the money going up is a debit. The credit is from whoever is giving you the money, whoever's putting it in your bank account. Say, okay, now we owe you more money. That's from their point of view, not your point of view. Okay. All right. Let's see here. Paid all of the accounts payable, $1,100 on June 29th. Okay, what accounts are we going to use?
Cash and accounts payable?
Yes and yes. So we paid him with, what do we pay him with? Cash. Wrote checks or something. Oops. Cash and accounts payable. So whenever you see paid, think cash. Or paid or payment made, that kind of thing. Okay, so cash. And oops, do it again. Accounts payable. Okay, the cash. Is it increasing or decreasing?
Decrease.
Yep.
So is the accounts payable.
Yep and yep. So accounts payable, cash is decreasing. And accounts payable is also, okay. What kind of account is cash?
Asset.
So, yep. And accounts payable.
Liability.
That's not how you spell payable, though. Okay, payable. Okay, so let's take the cash first. Cash is going down. It's an asset. Will it go down with the debit or credit?
Credit.
Credit, good. So it's going down, it's decreasing. So it'll be a credit. Accounts payable is going down. Debit, good. And again, I think we talked about this last time. If you know what one of them is, you pretty much know what the other one is, because especially if there's only two accounts. If there's three accounts, it might be a little bit more tricky, but if there's only two accounts and you know one of them's a debit, well, you know what the other one is, or vice versa. Okay, so we're at 6. So there's 20. Excuse me. I bored myself. Okay, so accounts payable. So accounts payable, liability, decreasing. For $1,100. Oops. And cash is going down with credit. It's an asset. It's also decreasing. Question, I think? Do you guys want me to do it on this thing too? I don't know if this is more confusing or not. Cash. And by the way, and if you're, you know, if the accounts, if you know, there's a lot of accounts here. And by the way, these are all new accounts to you guys. You know, and this will, I mean, you guys want cash, and you know what the other stuff is too, but where it goes, a little bit trickier. So everything, you know, in cash and assets, and liabilities and all that, especially these two, you know, if you're unsure where it goes, you can go ahead and look on the sheet. And this sheet is given, I put this out with everything. So, okay, let's go back to this. All right, so, all right. Oh, okay. This is something new. And it's something new because now we're going to get into, we haven't done anything with revenues and expenses yet. So we haven't done, you know, the revenues and expenses we haven't really done. And revenues and expenses are sort of counting money coming in and going out. For example, you know, if you have a business that runs on cash, you know, a hot dog stand, someone gives you money and whatever. So the money coming in is counted as it comes in. The money going out is counted as it goes out. Now, notice the only thing you're left with is what's left over, right? Some came in, some went out, and what you know, the only extra cash you have is the difference between those two. So it really is, they're kind of just counting things. Now, there is something great about revenues and expenses, and that is that expenses are virtually always going to be debits unless there's an error, and revenues are going to be credits unless there's an error somewhere. So expenses and revenues are, you know, expenses are virtually always debits, revenues are virtually always credits. Now, like I say, unless there's an error, something quirky happened. You know, that's really what it is. So that's nice because if you run into a revenue or a expense, you immediately know what the debit is or the credit is. You pretty much know the journal entry. Okay, so we received a utility bill. Now notice it doesn't say that we paid it.
So is that going to be like an accounts payable?
That's exactly right. Yep. Okay, so we have an accounts payable.
In cash, right?
Not yet, because we haven't paid it. Now, eventually we will have to pay it, and then we will have to use cash.
So we can only have one account that we're dealing with?
Actually, we're going to have an expense. So this would probably be called utilities expense. And that's not how you spell expense. So this is, it's going to be money going out. It isn't quite yet, but it will be. Accounts payable. And we have this expense. Oops. Okay, well, let's take the one we're familiar with, accounts payable. So now we owe these people, the utility company, $200. So are the liabilities going up or down? Do we owe more or less?
Up.
Do we, so you have this accounts payable, do we owe more or less?
More, right?
More, yeah. So this is gonna be an increase. Oops. Utilities expenses, they're virtually always increasing. Let's tell you why in a second here. Okay, so let's put down, we'll put these in here. So this is expense, so utilities expense. So the account, and this have liabilities. Oops. Yeah. Shaky cam. Letter which project. All right, so so expenses, you'll see that they're always debits. And say, well, why is that? Well, here's the thing, what's more, 1 month's worth of rent or 2 months worth of rent? 2 months, right? I mean, so expenses are always going up as the year goes on. Every month you get a phone bill, every month you get a utility bill, every month you get pay your rent and all that kind of stuff. So they keep going up and up and up and up. You say, well, why don't they go down? Well, expenses don't go down because I mean they can, but usually, for instance, the phone company doesn't, they don't send you a check. Oh, here's some money back, and maybe they do sometimes, but very rarely. So virtually always, the expenses are going up as the year goes on, and they'll keep going up until the end of the year. Then we'll know how many what expenses we had for the entire year. Okay, so they keep increasing throughout the year. So that's why they're virtually always a debit. Can they be a credit? Yeah, if you overpay something, they send you a check back or something like that. It can be, but it's fairly rare. Virtually always, it's going to be expenses are going to be a debit because they're increasing as the year goes on. Now, why is that great for us? It's great for us because if there's only two, there has to be a debit and a credit. What's ever on the other side is got to be the credit. Now, there's a reason why it is over here. Like we did before, accounts payable increasing is going to increase with a credit, but if you get an expense or a revenue, they're always increasing, and so expenses are always debits, revenues are always credits. Okay, July 1st. July 1st, 7/1. Okay, so utilities expense. And again, they're always going to be debits. Accounts payable. The liability. Plus in there. Okay. And always increasing. That's not 100% true, but it's 99.99% true, so I'm going to say it anyways. 0.01% of the time that I'm wrong is probably not material. Okay, so they're always increasing. So they're always increasing, they're always going to be debits. Okay, let's go to, any question on anything? Okay, let's go to this one. owe employees 1 week's worth of wages. Okay, so what is,
Would owe employees be cash?
Would it be accounts payable?
it'd be something, yeah, it becomes payable, or the book would probably tell you wages payable, either one. It's some kind of a payable. And there would be an expense, probably wages expense. That'd be the most, the usual. Oops. The wages expense. I'll tell you one of the weird things about accounting is we don't have standardized names for accounts. So wages expense and probably wages payable. It could be accounts payable. Yeah, on a test, I'll take any. A payable is the most. This is the most important word. Put it this way. This is the most important word. Yeah, if it's accounts payable, wages payable, employee payable, some kind of a payable, compensation payable, whatever it is. Something along those lines. Okay, now expenses, always increasing. Okay, wages payable, now this is a liability. Do we owe more or less?
Oh, more.
So it's gonna be a increase also. Oops. Okay. All right, so expenses, wages expense. And we'll try to spell it. Got a little dog barking upstairs. She weighs 13 pounds and she goes bananas.
I just peeped. You got all the guitars in the back. You play music?
I had them for a while. If you're wondering why those are up in the air, I'm in my basement. My wife has the office upstairs.
My ADD kind of took over, and I was just interested a little bit. But yeah,
Yeah, he plays. I have playing the best. The reason they're up off the floor, this basement flooded, so everything, is up off the floor. I'm in the basement. But yeah. Okay, so we just pay it. Okay, so yeah, and again, here's the beauty of running into an expense. You know immediately that it's a debit. Whatever's on the other side, whatever account it is, it's got to be a credit. Now, it is a credit because it's increasing over here, but the nice thing about this is if you're unsure, expenses are always going to be debits. Oops. That's not the right page. Yeah, by the way, I also have ADHD. I know what that's like. Okay, wages payable is a liability. And it's increasing.
For wages payable, can you just put accounts payable? Does that work too?
It's some kind of a payable. And like I mentioned before that we actually don't have standard accounts in account. I know it sounds strange because sit down and everything's exact and all this stuff. Companies call different things different. They might call this employee obligations.
Okay.
No, I mean this is I don't know if they still do this. The country that was the most I think interesting about it was Germany. Germany used to have numbers that went along with accounts. So they would say, okay, you can call it whatever you want, but the 100 numbers are cash. The 200 numbers are accounts receivable and so on. So whatever you called it, it doesn't matter because they had a numbering system that would tell you what it was. I always thought that was a pretty good idea. But,
Pretty German.
yeah, exactly. You can kind of do what you want to a point, and then we'll but anyway, yeah, it can be confusing. I mean, I've walked into places where you look at these accounts, you have no idea what they are. You have to kind of go in and look and see. You have something like I forgot, customer something, customer relations or something. You go, well, what does that mean? And you look into it. Oh, it's an expense. It's a customer service. Okay.
Okay, but in the future, we should put like wages payable. Like it's a similar question on exam. Would you want wages payable or is accounts payable?
Wages payable is probably the most descriptive of it because you're going to pay your employees. Whereas accounts payable is usually outside the place, but it honestly, I'll take it either way. I say the preferred way is probably whatever it is you owe. So we wages payable, salaries payable.
Okay, yeah, I got you.
Payable, whatever it is, yeah. Okay. Sold stock to an investor. 3,800. Now it's tempting to say, okay, this is a sale, right? This is a revenue. It's actually not. Because you're selling common stock. You're selling your ownership to an investor. So what accounts are we going to have?
Cash and equity.
Yep, cash, and then the account stock will be the equity. Yep. Oops. Okay, so cash. Is the cash going up or down? Does the business have more cash or less cash now?
Going up.
More, yeah, it's going up.
And kind of the tricky one, do we have more owners or less owners?
More.
More.
It's less because
More.
it goes to the investor
Less.
instead.
Actually, we sold this to investors. So we actually have more ownership. So now we gave them the stock. So if it's a new investor, we have another investor. But it could be we sold it to the investor we already had. But we have more ownership now going out. So this one actually has nothing to do with the revenues and expenses. I know I put it there. I'm trying to trick you. But when they say sold common stock, you're actually selling the ownership. So they give you cash. Now we have more owners though. Someone just gave us $3,800 cash. They're a $3,800 owner. So both sides of the equation go up. Cash goes up, and then the equity goes up because we owe them, or because they we have more owners now. Okay, so cash. I think all you guys know that's an asset now, so we don't have to look at that. And you already said that this was equity. My new way of spelling common stock. Probably not going to catch on, so I'll go back to the old way. All right, so this is so these are the accounts we have. Oops. Asset, an equity account. Okay, cash is going up with a debit or credit? Oops. Oh, come on, you guys are toying with me.
Credit.
Cash?
You said cash. I thought you had common stock.
Oh, common stock. Yeah, common stock would be credit. Yep.
Cash would be debit.
And again, this is one that, you know, it could be tricky because it looks like you sold something where actually what you sold is ownership. There is not a revenue. And but I think I told this before, but I should reiterate. You cannot make profit and loss off your owners. So there is no profit and loss being made off owners. You make profit and loss by selling to customers. Okay, so cash. Asset going up. 800. And common stock. Equity. So by the way, equity and liabilities are similar in a way. If you think about it, liabilities are what we don't owe to people on the outside, banks, that kind of thing. Whereas equity is sort of what's left over is owed to the owners. So after these liabilities are paid off, how much of the assets are owned by the owner. So it actually is it's not a liability, but it's similar in that, after the liabilities are paid, what would the owners get? That's kind of what you look at for the equity section. Okay. Okay, this is the wacky one. This is wacky because you'll see it two different ways in different books. Paid dividends. To stockholders. Okay, so what do we probably pay them with?
Cash.
Cash. So we paid dividends to stockholders. Okay, so well, let's take the easy account. Cash going up or down?
Down.
So cash is going down. And this is kind of the weird one. I've matched it up with the book, so it's the same way the book shows it. Dividends. Dividends are shown as a increase here. Now they're not an expense, but they are. There's a similarity in that it's cash going out. So dividends are a little bit tricky. I'll tell you the other way that they're shown, because dividends a lot of times will always decrease the equity section. Some books will show dividends in the equity section as a decrease. The book shows dividends as an increase, so similar to expenses. So I'm gonna do it the same way the book shows it. You'll notice that a decrease in the equity and an increase over here, they're both debits. Does it matter? Not really. But just know that sometimes you'll see it different ways in different books. International standards used to put the dividends in the equity section itself. They didn't have a statement of retained earnings. Okay, so dividends are always going to be debits. Cash is going down. So it will be the credit. So, July 14th. So anyway, so from our point of view, whenever you see dividends, yay, because you know exactly what that one is. Dividends, always debits. And cash is an asset going down. And again, you guys, you do not need to write this in here when I'm doing that. You just need the account. This is all you need. I just put that in there so to kind of show where the debits and credits come from. And truthfully, once you get used to doing these, this is all you see. Oops. And people who are familiar with journal entries look at this and go, oh, they paid dividends, 1,800. They wouldn't even need this up here to know that. They would just... And again, the concept of this is actually very easy. It's just take the accounts, pluses and minuses. That's all it is. It's getting in these debits and credits is the real tricky part, the real pain. Okay. 20. Perform services for cash. This is something new. So this is, we did whatever we're supposed to do, and they gave us cash for it. Let's take the easy one. Let's do cash first. Oops. Is there cash going up or down?
Up.
No. So we did a job for somebody and they gave us cash $2,800. Now the question is, what kind of account would be on the other side?
Revenues.
Revenues. Yep. And revenues are just money coming in. We're just counting money coming in. Oops. Now, the revenues are also always increasing. Why? What's more? What's more? 1 month's worth of revenues or 2 months? 2
2
months.
months.
Exactly. So throughout the year, it's always going to keep going up, which is good for us making journal entries because we know exactly what it's going to be. So this will be revenues. I should actually do something here for revenues. I'll make the journal entry and I'll make a point here. And cash is going up. So again, when you run into a revenue, it's kind of like running into an expense. You say yippee because you know exactly what that one's going to be. It can only be one thing. Revenues can only be credits. Okay. So, oops. All right. Cash is going up. Revenues always increasing. Unless something weird happens, they're always increasing, I should say. It's still increasing. I guess it is. Not giving me a nasty message, so. So revenues always increasing. They're always going to be credits. Could be something strange. Yeah, it could be something strange, or revenues entered wrong or something. But for the most part, you know, the 99.9% of the time, they're going to be credits. Now, I want to mention one thing about revenues too. Actually, I should have done this earlier for the expenses. Let me get this thing out of the way. Okay, when you look at your revenues, often called revenues, often called sales. You'll see those terms used interchangeably. They could be more descriptive. They can be service revenues, like this one we may have called the service revenue. Yeah, services. You could have called this service revenue. Repair revenue, they just bring up. One of the strange ones, though, you'll see a lot of times is earned. Whenever they say earned, they're talking about revenues. So most of the time you're going to see revenues, you're going to see sales, but you also might see this earned thing. It could be fees earned, commissions earned, revenues earned. So whenever you see earned, you know, this is also a revenue. And it may not be obvious if that's what they're doing, but whenever you see earned, think about revenue. Just one of the things that came up. I just found an error in my handout thing here. Look at expenses. Look at the expenses, cost, dividends. There's an error in there. What is it?
There's a payable.
Yes. Everybody, let's correct that. That should not be salaries payable. That should be salaries expense. So salaries payable should be salaries expense. That's my ADD working for me. As you're wandering off looking at things, and yeah, you find errors. The problem is the ADD also makes the errors in the first place. So change that salaries payable to a salaries expense, and I will change that on my my handout. Won't help you guys. The class after you guys will be set. All right. So yeah, it should be salaries expense. But the yeah, so but in revenues, we see if you see earned, the account earned, it's a revenue. Yeah, it was, you know, not completely obvious, but that's what it is. Okay. Billed customers for services delivered 550. What accounts are we probably going to use here? Now, notice, did the customers pay us?
No,
No, right. I mean, if they'd have paid us, we wouldn't bill them. You're not going to bill them if they had to pay. So we're billing the customers. So, and by the way, whenever you see billed, you'll know that the service is done. You know, you usually don't bill somebody until you've done something. So billed customers for services delivered. So what accounts are we probably going to use?
accounts receivable.
Yes. So they haven't paid us yet. They owe us some money. And how about the other side?
Revenues.
Yep. The revenues could be service revenues too. It really depends. Usually if a company only does one thing, they usually just call it revenues. If they do a bunch of different things, they might break it down. You know, this is service revenue, this is repair revenue, this is whatever. But a lot of times it's revenues, depending on what they're doing. Okay, so accounts receivable going up or down?
Going up.
Yep. Now they owe us 550. Haven't collected it yet, but it was 550. The revenues are always increasing. Always increase. So we have these two accounts, the types of accounts. We have an asset, accounts receivable, sorry. And we have revenues. Okay, so again, whenever you run into a revenue, you say yippee because you know that it's a credit. Now, accounts receivable is increasing, so that will be the debit. But if you know one side of the equation, you know the other side. And again, I don't care which one you put first. If you put the revenues first, as long as you credit it, that's fine. The book will tell you otherwise, but that's not really an accounting rule. That's just something, I don't even know how that came up, to be honest with you. Okay, so accounts receivable. Is an asset going up. And again, we count that as an asset because in the future, we plan on getting $550. And on the other side, we have revenues, and they're always going up. They're always credits. Okay. Question on anything? Again, revenues and expenses are actually, this is income statement stuff. They're actually easier than the balance sheet stuff. The balance sheet stuff, these go up and down. Cash goes up, cash goes down. Liabilities go up, they go down. Equity usually goes up, but it can also go down. So these can go kind of both ways. But for the most part, revenues and expenses, they only go one way. They only go up. Okay. Sale of services on accounts to a customer. So what accounts do we use? You guys are sleeping, aren't you?
Would revenues be one?
Yep, could be revenues or sales. Either one. They're exactly the same thing. The reason I say sales is because they say sales of services, but it could be revenue. Either one. We use revenues. Probably, I'd say probably 90% of companies use the term revenues. Probably the other, 9% use sales, and the rest of them use whatever they want, I guess. It is confusing. I'll take the sales. But it could be sales though. Okay, and they're always increasing. What's going to be on the other side?
Accounts receivable.
Yeah, now they owe us. Accounts receivable going up or down?
Up.
Good. They owe us $810 now, so this will be increasing, and we count it as an asset because hopefully shortly it'll be turned into cash. Okay, so revenues. And accounts receivable. Here's something weird I noticed, and this is just in Word. So it goes down to 2 lines here. When I bold it, which you think would make it bigger, it goes back down to 1. Isn't that weird? Weird things. All right. I didn't mean that to be interesting. It's just, it's just a weird things happening on my computer. Okay, so let's take a look here. So okay, so revenues again. Once you hit revenues, yay, because then you know it's a credit. Whatever the account is you have on the other side is going to be the debit. Okay. So accounts receivable. And so you know, once you get kind of used to doing these journal entries, you know that there's a handful of rules that are again, it's a kooky shorthand, but as you get more familiar with it, it really does become much less likely to make a mistake. You know, do they happen? Yeah, they happen, but if you end up with 2 debits or 2 credits, you know something's wrong. So it's actually kind of a self-correcting. And not only that, if you're positive about one of them, you know, I know revenues always credits. You know, the other side has to be a debit. So you know there is a kind of a built-in thing to doing it correctly. Now, yeah, people might say, yeah, I did an audit one time, and they put in a journal entry at the end of the year. They thought it was wrong. So when I think it's wrong, they reverse it out. Like if I put this in and I thought it was wrong, oh, I put that in, I'll just reverse it out. You know, they make an error. Then I thought, you know, this is right. And they put it back in. They did that 6 times. You know, that's how unsure they were about this journal. And it just happened to be that they made it at year, you know, when they made it at year end, it was like the 3rd go around with it. And it went it was a correct journal entry. It was the right journal entry. But you know, then they reversed it out and put it back in 3 more times the next year. But it you know, so you know, did it happen? Yeah. Is there sometimes confusion? Yeah, but you know. All right. Wages owed to employees at the end of the month, $390.
Wage expense and wages payable.
Yep and yep. Let's get these over. Yeah, so wage expense is what we owe to the people, our employees, and wages payable. If you put accounts payable, that's fine. It'd be some kind of a payable. Okay, wage expense. Nice thing about expenses, always increasing. Okay, payable. Do we owe more or less?
More increase?
Yep, do we owe more? Right, we owe them $190 more actually. Okay, well, let's take the super easy one, wages expense. We know exactly what that one's gonna be. So that will always be a debit. And wages payable is a liability.
Clark said if it happens again, he's automatically gonna fail you in this class.
All right. Okay. $24 paid current month's rent, $2,200. What did we pay them with? Anyone?
Cash.
Okay, so we paid. Rent. So accounts we're going to use cash, obviously. And what's probably going to be on the other side?
Will it be prepaid rent?
Yeah, good answer. If we were paying it for the next, if we're paying into the future beyond the current month, it would be. If we're paying for the current month, you know, that whatever it is. So what is this, August? So if we're paying for August, it'll just be an expense. But yeah, if you pay it into the future, if you pay rent into the future, which is common, it would be a prepaid. But for right now, it'll just be a rent expense. Actually, chapter 3 will get into that. The prepaid. Okay, so cash. Okay, is our cash going up or down? Oh, come on.
Down.
Down. Nope.
And expenses are always increasing. What's more, 1 month's worth of rent or 2 months? 2 months, so rent expense. Oops. Oops. Okay, so that's gonna be an expense. And our cash went down. This will be a debit. Cash will be the credit. And again, whenever you run into an expense, you say yippee, and because you know exactly where it goes. All right, so I think we'll stop here. but try 25 and 26 on your own.
Hey, Professor, can you scroll up to 24 real quick?
I can.
Thank you.
Wait a minute, this is kind of a funky thing going on here. It should not be like that. It should be like that. Okay. Okay, so we'll stop here. Try 25 and 26 on your own. $25, you purchased some supplies on account. And on 26, you paid for those supplies. So this will kind of show you the cycle, of buying something and then later on paying for it, which is very common in business, honestly. So see if you can do that one on your own. If you want to try 27 and 28, these are tricky in that this is these are unearned revenue ones. So try if you want to. You can give it a shot. I mean, we'll go through them. I'm gonna look at the right answers and all that. So if you want to give those a shot, those are a little bit more advanced, but it's basically a customer paying you in advance. So unearned revenue, and this is of course, well, not of course, but this is a liability, which we haven't done anything with it yet. So if you want to give those two a shot, you can give those two a shot. So we'll call it a day, and we'll meet back here, same time, same bat channel for finish up the handout, and I think we're gonna do. I think we'll probably do a problem or two out of the book, which I should have with me. At least for the two that we're doing. I might give some of this homework too. But for right now, we'll finish up this next class, and then we'll do some more practicing on these. And again, the reason we're practicing on these is just because it's so weird. The more you do, the more used to it you get. And it's just the way it is. These are not intuitive. If you weren't in this class and someone showed you, this. Oops, if you weren't in this class and someone showed you this, it would make no sense. You wouldn't even know what it was. I mean, most people, if they look at accounting, they don't know what it is. So anyway, so try 25 and 26 for next class, everybody. And then if you're ambitious, you try 27 and 28, which are the unearned revenue ones. Any questions? Okay, I know you guys got class to go to. All right, I will see you later. All right.
Thank you.
Thank you. Thank you. Have a good one.
You guys.